Welcome to our channel. So today we'll be looking at inventory valuation. So for inventory valuation, we look at the methods to value closing stock. That's pretty much the key thing. We want to see or we want to calculate what the value of our closing stock is at the end of a particular year, right? And mainly, the reason we have to do this is because of something also you would have to know, which are the systems, inventory systems. You have your periodic and you have your perpetual inventory system, if you remember perfectly. If you can't remember that, you will see I'm going to do a video for the grade 11th. It focuses on the systems, right? So then you can look up that video on our channel for the grade 11th. But for the grade 12s, we like to focus more on the methods to value the closing stock. And really, the reason we even need to value the closing stock is mainly because of this inventory system called the periodic, right? Because if you remember perfectly, right, the periodic inventory system does not keep record of how much stock you've got every time you make a sale, right? So you can only find out how much stock you've got, how much you sold, how much stock you've got at the end of a period. Whereas with the perpetual, you get to find out these things as the year goes by. As you sell, you find out more what the value of your stock is, right? So that's why here in this question, where we have to value the system, use this periodic because it only makes sense. Because these inventory methods, we use them these valuation methods, we use them to value closing stock. And it's really key. On the periodic inventory system, if you remember, I just want to remind you of something quickly. If you remember how we calculate our cost of sales, because we can't keep record of our we can't keep record of our stock every time we make a sale. We don't really know what the cost of sales is until the end of the year, right? So when we keep record of our cost of sales, you will remember what we do, how we calculate our cost of sales at the end of the period. We go on and say we've got our opening stock, yeah, at the beginning, and then we add the net purchases, yeah. After adding the net purchases means you have excluded returns. Remember, you have already accounted for returns, and then you can add the carriage. This is the cost of carrying the goods into your place. Carriage and purchase. Yeah? You get it. Yeah? So, you've got all of those things. You've got their values here. Right? Whatever the values are. Right? And if you think about it, really, the stock you've got at the beginning plus the stock you bought during the year plus any cost of transporting that's the value of your stock, right, for the year, right, that you have. That's the value of the stock you have for the entire year. Now, if you take out the stock that's left at the end of the year, which is your closing stock, yeah? If you take that out, what are you left with if you think about it? So you take all the stock you own during the year, yeah? You subtract this. So you take all the stock you owned during the year or that you had during the year. You subtract the stock that you have at the end of the year. That means that whatever value you get here is the stock that you actually sold, the value of the stock you sold, right? And that is what you call your cost of sales. Yeah? So this is the method in which you calculate cost of sales using the periodic inventory system. If you are under the periodic inventory system, I mean. Okay? So that's how you get your cost of sales. So do you see this value here, this closing stock value here? It's very important. You must know this closing stock value here, right? And these methods help us to know this value here, right? And basically, I'm just going to get quickly into the basics of this. Basically, yeah, basically you've got how many methods to value this, or which methods? You've got the FIFO or the Fifo, or first in first out. You've got weighted average, and then you've got specific identification. And really, like, they explain themselves. But in this video, we'll be looking at particularly the Fifo method, and we'll be looking at last year's question paper, final exam, right? We're going to look at last year's final exam, and then we're going to consider only the Fifo method. Then we'll do another video where we look at the weighted average method and the specific identification method. Okay, so I hope it will be helpful. But yeah, this is our focus for this video. I will explain the rest in the other videos, right? So the focus for this video is the first in, first out. It's quite popular and it speaks for itself. If you think about it, what is it saying? The first stock that comes into the business is the first stock that goes out of the business. In other words, the first stock we sell. And it only makes sense. If you sell something, you probably, when you stock up, you're gonna sell that which is stocked up first, right? You're not gonna stock up now, stock up the next month, and stock up the month after the next one, and then you sell the stock you stocked up first. You get my point? It makes no sense. You always sell the older stock first, in other words, okay? Which means that when you've got stock left, it's the newest stock that's left. Does that make some sort of sense? So the newest stock is the one that's left. That's pretty much the case. So we're gonna look at this question, guys, quickly. It shouldn't be too difficult, and then we're just gonna try and make sense of it. I'll make more videos, which probably would be a bit more complicated, and that's fine. I'll consider the other videos which are maybe more complicated. But this is the November paper, yeah, November 2019. That was written by the Matrix and who wrote in 2019. I think it was fairly simple. So we've got this company called Grande Limited. Yeah. Now this company, you've got the majority shareholder as George Grande. Okay, that's fine. They have a year end of 30 September 2019. Okay. That's fine. So let's see what is required of us. Yeah. 3.1. Calculate the value of stock for the cabinets on 30 September 2019 using the first in, first out method. There, your first 6 marks is they want you to calculate the value of the closing stock. Yeah, so we're gonna do just that. So this is the information they would have provided you with. Yeah, so we are looking at cabinets here, so it's very key you mark what you're looking at, otherwise you'll lose information for the other stocks, because they seem to have cabinets, they seem to have lamps. They deal in hotel supplies. Yeah, as it's written here, hotel supplies. They supply hotels with cabinets and lamps. Okay, so we are looking particularly at cabinets because that's where the first in, first out method is being applied in this business. Yeah, so they want us to calculate the value of the closing stock, right? So what we have here is the stock balances. Okay, we've got at the beginning, so 1 October 2018, because it ends in September 2019. So 1 October 2018, we've got 370 cabinets. And then at the end of the year, we have 280 cabinets. So there, they've given it to you. They told you how many lamps you've got at the end of the year, right? So you've got 280. So closing units, right? So your closing units are 280. So this is 3.1 that we're looking at. You've got 380 units to closing, right? But now, what is our principle when it comes to first in, first out when we want to value this? Remember, like I said, the first stock that comes into the business gets sold first, which means the last stock that's left would be the stock you bought last during the year, right? So let's look at this. You've got stock at the beginning of the year, right? This is you began the year with. I would think you would have sold this first, right? And then you made purchases in January. That means that the next sales you make, you're going to make from your January purchases. Then you're going to make from your April purchases. Then you're going to make from your July purchases, right? So that's the total that they bought during the year. So that means that if there's anything left, it would be left first in the July stock, and then in the April stock, and then in the January stock, and so on and so on. So when you calculate the value of the closing stock, you move from bottom up. That's how it works. Yeah, great. So we're gonna look at this particular question, and something that can be tricky that you can easily miss is the returns. There are returns here, right? So they bought stock during the year, right? They returned some stock, 20 units. Yeah, but you need to know from which purchases was the 20 units returned. And what will tell you in this case, since they didn't give you any information, what should tell you in this case is the unit price. Or how much did they buy each cabinet? And the price for each cabinet is 1,100, right? For these returns, which means they were returned from the July stock. You bought, because in the July stock you bought each cabinet at 1,100, right? So your returns, since they're at 1,100 each, that means it's from the July purchases. You get my point? So in other words, for your July purchases, they are no longer 250. How many are they? They are 230 because we're gonna take out the 20 units that were returned. And I hope that makes sense. You cannot miss that. If you miss that, then it's gonna screw your entire calculation up a bit. But don't, yeah. So with accounting, it's all about reading between the lines and not missing details. Because if you miss details, it can mess up your calculation. But in any case, let's get to it. Let's calculate then the value of this closing stock. Yeah. So we said that we'll move bottom up to calculate our closing stock. We'll move from bottom up, right? Which means that the amount that makes up this 280, the units, they start from July, right? But in July, how many did we buy? 230. We bought 250, we returned 20. So in other words, we only have 230 from the July stock, right? So from the July stock, we've got 230 units at 1,100 each. Yeah. But that doesn't make up 280 yet, right? So we're still missing how many more units to make up 280? 50. So where will this 50 come from? Remember, bottom up, right? We started from July. That means that what if there's still anything left, it would have been left from the April stock. Now your April stock goes for 990 each, right? So they bought each cabinet there at 990. Multiply by 990. You see that? It's that simple, guys. And then you whip out your calculator, you calculate your closing stock. I'm gonna whip out my calculator. What am I doing? 1,100. Oh wow. I don't think I had breakfast today. Okay, 1,100. 253,000, yeah? And then here, 50 times 990, 49,500. You see, if you missed the 20 units that were returned from your July stock, if you missed those 20 units, what you were going to do, you were going to say from the stock that's left, 250 is from July, right? So instead of having 230 here, you were going to have 250, right? Which means your stock was already going to be, your closing stock was already going to be too high, right? So you're going to calculate the value of your closing stock. You get the total, 253, 302,500. And really, that's how you use FIFO, okay, or the first in, first out method. That's how it works, right? It's pretty simple. It's straightforward. I think it's one of the best methods of valuing stock, but yeah, maybe you have your own opinion. That's good. You should all have opinions. So we're gonna go to 3.2. You've gotten your 6 marks there. It should be quite simple. 3.2. Now, in 2019, the company decided to extend target market and to grant trade discounts to increase sales. Okay, good for them. Now, what is required of us? They want us to calculate the markup achieved in 2019, right? Now, this is one of those things you would have learned in grade 9, how to calculate markup, right? But you could have forgotten. You are forgiven to forget. Like, it's fine. I also forget sometimes. But now we have to calculate the markup, and hopefully you can remember the methods of calculate. Those not methods per se, but the formula to calculate your markup, right? So what is markup, first of all? Because maybe you just calculate it every time and you don't really understand what the thing is, right? Markup it's a percentage. So in percentage, how much profit do you make on your sales? Does that make sense? Like, how much gross profit do you make on your sales? So remember, if you buy a table for 100 rand, but then when you sell it for 120 rand, it means you add an extra 20 rand on top of the cost. Do You get my point? But how much is that in terms of percentage? That in terms of percentage is 20%. It will be 20 divided by 100, which is the cost of our table, right? So it's 20%. And if you think about it, what is your 20 represent in your income statement? It represents the gross profit, because we just said that it's your sales minus the cost of sales, which is the 100. It gives you that 20. That 20 represents your gross profit. So in essence, the formula to calculate the markup achieved is gross profit divided by cost of sales, or the cost of the goods that you sold. You get my point? So in this case, you're going to follow the same formula. So that's why, what is markup? Markup is just the profit you make on top of your cost. So you buy something for a cost, you sell it for a selling price that is an added markup. Okay? Because you want to make profit. You can't sell it for the amount below what you bought it for. You want to sell it for an amount above what you bought it for. And that amount above is your markup. So that's all you need to calculate here. So we just concluded that your markup, right, equals gross profit over cost of sales. Yeah. Now you have to then look at the information and ask yourself, okay, what's my cost of sales? What's my gross profit, right? Now your cost of sales, sometimes they will ask you to calculate it using that method I showed you, right? This method, right? They can ask you to calculate cost of sales, because now you have calculated what the closing stock is. But in this case, they didn't ask you to. That's why it was only 4 marks. They gave it to you, I believe, right? They gave you the cost of sales, and then they gave you, I think, gross profit. Yeah. Okay, you could calculate gross profit. They didn't give it to you. So the cost of sales is 2,170,500. This is in relation to cabinets, and we're looking at 2019, right? So your sales was 3,480,000. Your cost of sales was 2,170,500, right? So you have to calculate first your gross profit, right? How do you calculate gross profit? It's sales less cost of sales, right? So 3,480,000 minus 2,170,500. Yeah. Then you'll get your gross profit, right? 3,480,000 minus 2,170,500. So 1,309,500. Yeah. We are good to go. So that's your gross profit, right? So our markup will be using that formula. Gross profit over cost of sales, which is 2,170,500. Yeah, it must be in percentage, right? So if you plug that into a calculator, it will give you in decimals. But if you want it in percentages, 100, you have to multiply by 100 there. Yeah, and then you'll get an amount of 60.35%. Is it? 0.33%. So that's the markup. So for every sale you make, you add an extra 60.33% for profit. That's pretty much what it's saying. Okay? And that's how you calculate it. So that's simple, I'm guessing. And then the other 2 questions are questions you just have to think about when you answer them. Yeah? Provide 2 points with figures to prove that this decision achieved its aims. So here you just have to look at information, right, that you've been provided with, and then consider which information here supports the idea that their method to increase sales worked. Well, you look at first sales. I mean, it's only logical, right? You first look at sales and say, okay, did sales actually increase? So from 2018 to 2019, yeah, sales did increase. So you can use that. You can quote these 2 to support that it worked. But what else can you use, right? Remember, they're giving trade discounts now, and they're trying to get more people to buy from them. So you can see customers on record. Don't know if you can see, yes. So you see that customers on record were 26 in 2018. Now they are 37 in 2019. You see that? So your customers on record have increased. That's a sign to show that your method has worked, or your strategy has worked, right? Great. And then The rest of the question 3.2.3, the CEO feels that this decision also negatively affected the company. So there are some negatives to this decision. Provide 2 points with figures to support this. Okay? So now we have to look at things that say, well, maybe it didn't really work that well. Well, it worked, but it didn't work that well. Alright? Those things could be, in this case, markup. We just calculated the markup to be 60.33%, right? But look at last year's one, it's 73%. So obviously last year we made more gross profit. You see that? We made more gross profit last year than we did this year. Now also units sold. I mean, yes, if you're gonna apply a strategy, you also want the number of units you sold to increase, not just the customers, right? If you look at the units they sold last year, they sold 2,500 cabinets. This year they only sold 2,320 cabinets. So that might show that, okay, this thing might not actually have worked. Okay? So numbers are tricky. You see, you can't just look at two numbers and say, oh, the company is doing well, right? You need to go deeper. Give the directors advice to solve this problem. Explain 2 points, right? You just need 2 points to give them advice as to how they can solve the issue. So again, if you look at the information they give you, right, you can sort of come up with a strategy or something. Use your head, right? But when I look at this, I don't really have time to think about this question per se. But when I look at this, I think to myself, well, for one, if you look at their cost of sales, it's quite high, right? This last year it was 1,950,000. 1,950,000. This year is 2,000,000. That's affecting their gross profit, because if you have a higher cost of sales, that means you have a lower gross profit. So maybe they should consider buying from different suppliers, because the suppliers they're currently buying from are probably too expensive. Do you see that? So consider buying from a different supplier. Think of other things. You can think of, well, trade discounts maybe do not work, because trade discounts actually, like, they're not, we can see customers have increased, but we are not seeing more people buy, more units being sold, right? Maybe let's invest more money in advertising, right? Instead of a lot of trade discounts, let's take more of the cost into advertising, and that could be a strategy. Guys, I hope this was helpful. We're gonna do another. We'll do a part 2 where we'll look at weighted average and specific identification. Please do comment, leave a comment, and I will answer your question. And also look at this question paper. It's the November 2019. As you follow through with the video. Okay, subscribe, leave a comment, and we'll give you more.